Hey guys, welcome to the channel. Texas local lender William Branch here. Want to come at you today, talk to you about the dreaded PMI. What is that? PMI is what's considered private mortgage insurance. Should you have it? How do you know it's going to be required? Not all loans even have PMI. So first of all, let's talk about VA. VA doesn't have any PMI insurance on it. Your FHA is going to have what's called an upfront fee. It's going to have also a MIP. It's a little bit different. It's a different name, but that MIP factor is going to be constant throughout the loan. So why would you go an FHA loan versus a conventional? Conventional loans are going to have what's called PMI, and then you have USDA that have their own criteria. PMI is always going to be required, or typically going to be required, when you put less than 20% down. So can you put less than 20% down and not have PMI? That answer is yes. You could potentially do a second lien on that loan. So sometimes that's a good case. You have people that are just adamant about not having it. Typically, it can affect your interest rate having two liens. So what I find, especially in this market, is that PMI is so cheap that the amount of interest that you would pay over the life of that loan having two loans doesn't make sense. So we're seeing that appreciation is going up, that in 3 to 5 years, typically we have been seeing that people are refinancing out of their home, getting rid of their PMI, lowering their interest rates. So a great way for you to think about, hey, should I have to put 20% down or should I do a first and second lien? All of that matters in structuring your loan. Does PMI fall off? So that answer is yes. With conventional, it does fall off. It typically will fall off in about 105 months, depending on how much you put down. So if you put minimum down 3 to 5%, it's about 105, 108 months on average if you don't pay any additional principal. Typically, this will fall off at 78%. You can also call your servicer at 80% to have that requested. What they're going to require on that is going to typically require an appraisal to be done, and you can get your PMI removed. So let's just say, like in this market right now, interest rates are a little higher. Well, William, I don't want to refinance. How do I do that? Call your servicer today. Tell them you want to request it. They'll order an appraisal for you, and boom, your PMI is off your mortgage. So if PMI doesn't fall off on FHA, why should I use an FHA loan over a conventional loan? So we're going to typically go with an FHA loan due to a lower credit score, because on FHA, your PMI is going to be constant. It's at 0.85 unless you put a little bit more money down. On conventional, it typically likes your higher credit scores. It's going to have lower PMI with the higher credit score. So the lower your credit score, the higher that PMI goes. So if that PMI gets over 0.85 or maybe even above 1.25, it may make more sense to actually go the FHA route. On a conventional loan, the lower the credit score, the higher the interest rate too. FHA, the interest rate's not as affected with lower credit scores. So those are two reasons why you should go FHA versus conventional. In this market right now, I'm a big advocate that we have people that come at us and say, hey, I want to save, I'm just going to save till I get to 20% down. Well, in this market the last 2 years, we've had appreciation of 20 to 30% appreciation per year. That's insane. Normally we have 3 to 5%, which is on average. So you can figure that if you have 5% appreciation per year, in 4 years, you could request to have that PMI to come off of your mortgage. So just think about that. If you waited till you had 20% and it may take you 2 to 3, 4 years, well, you already gained that 20% by living in that home. So don't go waste money on rent and having to wait, because that's a complete myth. I tell people all the time, let your money go to work for you, because if it's all in your house, you're only gaining appreciation. It's like a savings account, whereas if you can put money in the market, time value of money, 5 to 7 years, typically your money will double on average. And we can get you in touch with a wealth advisor to talk more about that. But these are great solutions, great things that we talk about on a consistent basis with our clients, our first-time home buyers, of why should I go conventional, why should I go FHA, and that PMI factor, what does all that mean? I want to say thank you for tuning in today. If you haven't liked and subscribed, click that like button, subscribe button below. We will see you next time. Texas Local Lenders, see you later.